All right, today's video is on yield curve, specifically yield curve inversion, and more specifically the 10-year treasury term and the 2-year, and how the 10 is supposed to be above the 2, but sometimes they flip, but usually it's not until after they unflip, uninvert, the 2 goes back below the 10, that the recession kicks in shortly thereafter. So let's dive into the charts. Should be a quick video today. Only two real charts to look at. Just the S&P 500 with the green overlays are U.S. recessions. And then we're going to take a look at the yield curve and how a recession usually follows an inversion in the yield curve. But here we are trying to figure out what's going to happen. So this is the 10-year U.S. Treasury yield. And we're going to switch this over to a line chart. And then we're going to add the 2-year, because the inversion of the 2-year and the 10-year, and I only get data back to 1988 on this. I'm not, I assume that the 2-year was around before then, but I'm not sure why it's only showing up. But that's okay, because we're just going to look at sort of like modern history anyway. But basically, for a shorter term, 2 years as opposed to 10 years, you'd expect to get a lower return. So for 10 years, if you lock up your money for 10 years, you get a better return. You lock up your money for 2 years, you get some return, a safe return, but less. And at times, that chart inverts. So you can see here, in 1989, we got a yield curve inversion, and then a recession followed, starting around summer of 1990, and it went through 91. This is basically like the dot-com crash. The curve inverted early 2000. Technically, the recession was not until like the second quarter of 2001. The great financial crisis, they basically kind of matched up for a while, and there was a slight inversion, and that happened around early 2007. And then again, technically the recession wasn't until 08, lasted through 09. When we look at the S&P 500, we'll see that, recession versus bear market is slightly different. We've got this little blip here where it looks like it didn't really invert, but this is COVID. So, it was like this really quick recession. And now we've got an inversion of like basically what looks like epic proportions, where the 2-year is well above the 10-year and has been for a while. And it's just like, what is going to happen as we go along? Because everybody's predicting a recession. But if you'll notice, and Ben Cowan was the first one I ever saw point this out, it is not until after it uninverts do we actually get the recession. So these green overlays are when the recession occurred, and we're going to look at the S&P 500, and it'll make a little bit more sense. But you can see that the orange line is the 2-year, and the blue line is the 10-year. And after we get an inversion, as in the 2-year goes above the 10-year, but then it's not until we correct and we get back to the way it's supposed to be that we actually get the recession. So it's sort of like when the 2-year goes above the 10-year, something's wrong with the economy, and eventually that component fixes, but then it's not necessarily causation. It's not necessarily like the yield curve causes it. They're all sort of symptoms of the same thing. But as you can see, it doesn't really happen until the orange goes back below the blue. So that's why it makes sense that we're not really in a recession right now. So once the orange crosses back under the blue, I think that's when everybody really needs to worry. So I can understand being cautious right now, because you're like, well, that has to happen eventually. So a recession is coming. But what if a recession's a year out? What if a recession's 2 years out, 3 years out? Now, I don't know if there's any reason to think that the recession is going to be pushed that far out, because we're kind of in, at least from what I can see, uncharted territory with this 2-year this far above the 10-year. So let's look over at the S&P 500, and you can see here, especially this highlights how the recession doesn't necessarily match up with the bear market. So this is in 2000. You can see both the market was a long way down, was crashing a long way, and then continued to crash longer than this recession was really indicating. So to me, I think of this whole time from March 2000 all the way to through January 2003 as like the recession, because it's the bear market, and that's what really matters for us. I mean, obviously everybody wants to have a job. If you lose your job, then that's what you care about the most with the recession. But when we were looking at investments and stuff like that, the market was still well on its way down. This says that the recession ended in November of 2001, and we didn't really start recovering in the market until April 2003. So similar with the great financial crisis, you can see that we kind of topped out a few months before the recession technically hit, and then we were kind of climbing our way out of it. Um, before the recession was technically over. So now here we are. I'm wondering if somehow we could have thrown off this economy so much that this was actually the recession. That's obviously very hopeful, wishful thinking, because it means that we won't be going down anymore from here. But let me throw it back on candles. But obviously, everybody gets super interested in a recession when you see a big red monthly candle like this. So right now we are down from the recent top. I mean, it's only 5.5%, but obviously, if this continues, if this is the beginning of something like this, and we go down, a similar amount, if you look from here to here, if we were to match something like that, I'm not saying we're going to, but I'm just saying, this is what everybody gets fearful of. They'll take us all the way down to 3,200. I don't think that's going to happen, but it could certainly double bottom, and hey, it could happen. We could have a massive, massive crash, but it seems like we'll need to wait until an uninversion here. It doesn't mean it has to happen that way. We may be able to experience a recession before the uninversion, but history shows that typically happens first. So keep an eye on that 2-year versus the 10-year yields. Right now we're inverted, and we're still, mostly on the rise. I know a lot of people, you're captive of the moment, and you feel like, hey, we're down 5%. We're going to keep on going down, keep on going down. This is a rough month, but this could also be a very healthy correction. You look at when we were climbing out of the pandemic, we had a lot of red candles that people were probably freaking out. And eventually, we just kept going stronger and stronger. So that might be happening, or this could be the top, and we could be going down from here. But the yield curve indicator, basically has not flashed yet. All right, so that's the yield curve inversion. I will see you guys next week for more charts.